Well, good morning, everyone, and we are now welcoming you to our first M&A related webinar, and I'm extremely happy to introduce our hosts and guests today. And I'm happy that we have William Wells, Executive Vice Chairman at Rothschild and Co., and Julius Grigaliūnas, Managing Partner of Porta Finance. We have also Elius Burgis, our partner and head of corporate transactions in Vilnius, Cobalt law firm. We have Juozas Rimas, head of our M&A team in Vilnius, and also we have Peter Kutman, M&A partner from Tallinn, and Gunter Zīle, M&A partner from Latvia, Riga, Cobalt. So thank you for joining us. Unfortunately, I cannot see all the audience, and I see only my fellow hosts. But I trust that our webinar today will attract interest and attention from those who are watching us and listening. And today we will be covering topics related to equity and debt markets in the Baltic countries, as well as Central and South Eastern Europe, and maybe a bit of a view on what's happening globally. We also present our lawyer's perspective, how deal making is changing, and what new terms and conditions are being discussed and negotiated when considering transactions. And we will have also time really to answer your questions and discuss and listen to your comments, and maybe discuss the issues that are of your interest. And thank you very much for joining. And without further ado, and I would like to ask maybe William to start with an introduction of situation in Central and Eastern Europe, and maybe present your views on what is happening now and maybe what to expect in the coming future. So William, again, thank you very much. I think, I hope your travel to Vilnius was safe and you are now good to present. But thank you, William, and the floor is yours.
Okay, Imotas, thanks very much. So for those of you that don't know me, it's William Wells. I oversee all of our businesses from Rothschilds in Central and Eastern Europe, and I'm responsible for our exclusive affiliation with Porta Finance across the 3 Baltic states, where Julius and I and his colleagues work very closely together on a number of things. What we'd like to do today is talk a little bit about the international and local backdrop to current situation. You'll have seen lots and lots of statistics, but it's quite important that one has a bit of a perspective on the environment. Julius will talk a little bit about the more local marketplaces, and then we'll talk more about the prospects for M&A. But just to say that there are 2 really important considerations here. One is, let's describe it loosely as the moral hazard of government assistance in this sort of managed lockdown, which creates some interesting issues. And then secondly, we're already seeing it across Europe, the focus on how to manage and repair balance sheets. And that is the key issue as to how corporates and other institutions are going to behave. So if I talk a little bit first about the backdrop, just to give you a short-term perspective, because that's what it is, it's a short-term perspective. So Julius, if we can... So I think an important thing to remember from this slide is that this is one of the fastest market reversals, but actually reversals and bounce backs, but actually it's by no means the deepest. When you work at a firm like Rothschild's, you're very conscious of history. We don't stretch back to the Black Death in 1381, but or at least we have no records of being active at that time. But we have a very, it's surprising how we look at it in this sort of perspective. So there's no question, in market terms, this is very significant, but it's also very fast. And I think that's the thing that people need to keep reminding themselves, is that actually we're really only talking about the last 6 to 8 weeks. But it's very, very real, and uniquely outside world wars, it is a planned recession, effectively. If we go to the next page. It's clearly going to have a huge impact on world economies. What we seek to show here is what we would expect to see as the impact on real GDP year on year for 2020. Again, if you think about this in terms of being a 1 quarter plus, maximum 2 quarters plus impact, it is quite extraordinary. And the Eurozone, pretty significant. Central and Eastern Europe, less so, partly because, well, in my view, partly because some of the actions have been by governments sort of less comprehensive, and therefore people are being to sustain themselves more. Some being very severe, but also Central and Eastern Europe hasn't really faced the same level of infection rate and mortality as the major urban centres and the major economies of Europe. So, we come back to this basic model that most people seem to be working off, that from the moment that more than 100 infections a day were being reported, I beg your pardon, 100 deaths a day were being reported, there seems to increasing evidence that we're looking at about 8 weeks before the infection and then subsequently the mortality curve flattens or starts falling. And if you started earlier, well, hopefully you finish earlier. Okay, none of this is certain, but it just gives you a sense of time. So let's, go on to the equity markets. I mean, it's dramatic stuff, and markets, of course, do react short term. There's sort of quite a lot of this here, but in our part of the world, the markets follow the larger markets, no great surprise. But the point that people should appreciate is the extent to which, from the mid-March lows, markets have rebounded. And that tends not to be remembered by people, but we've sort of moved in many instances, in the main markets, we've moved a third, if not almost half, 40% of the way back. And smaller markets where liquidity is less and the investors tend to be long holders are much slower to react. But the key point, the market come back. Always the question that people are asking us, which are the sectors most effective? Again, it's worthwhile having a time perspective. I mean, the left-hand column about Wuhan going into quarantine, severe. Within Europe, the recognition of the impact on Europe, probably a bit more severe, in some cases definitely more severe. But look at where we are last week. There is something of a recovery these are all listed stock prices and indices. There's something of a recovery. you would still probably suck your teeth about being a major investor in travel and certain forms of leisure at the moment. Certainly sort of travel infrastructure, or automotive. But there are already people are beginning to look at value opportunities in different sectors as portfolio investors. But again, the thing I'd like to stress is the timeline. Valuations. This is something that we'll come back to as a major issue for deal activity. Actually, we're back to the trend line. Everybody likes averages, but the historic information proves them to be reasonably comforting. But one of the key issues is the sustainability of that. And there is a slight distortion here because you're seeing price earnings multiples going back to the trend line, but the earnings are a lot lower, or likely to be a lot lower on a forward-looking basis. So, but we'll come back to this major problem that'll slow transaction activity, which is valuation. Our marketplace, slower, is a follower, but essentially will follow the same trend. The major markets here, and volatility, which is the key investor concern, as shown by this the V2X equity volatility index. We are back to great financial crisis levels. But I would argue, and I think a number of our clients are sort of feeling that this is once again self-induced volatility. It is there's a degree of managed volatility. The thing that really will end the volatility is a vaccine. But for all of the stories, it's pretty clear that that's going to be many months away, even if that is a dramatic improvement on SARS or whatever. Take volatility as a measure of confidence in being able to hold valuations. It's pretty brittle, but it also has come well off the peak now. If you look at the pull-out box, perhaps Julius just flip to the debt markets. Julius,
unmute, please.
Okay.
That's right. I was just, William, adding that the volatility, despite the coming down, is still above the levels where equity sort of issuance or IPOs could be acceptable.
Oh, absolutely. Very good point. Okay. Big question that everybody has is, given the level of sovereign action in this induced recession, what is it going to mean for the benchmark credit ratings of sovereigns and so forth? Well, the credit rating agencies are moving into a big period of assessment of sovereign risk. They're slightly delayed in our part of the world because waiting to hear from EU leaders as whether or not there's going to be a major assistance package. As you all know, last night, I think it was last night, there was another video conference meeting that sort of broke up inconclusively with rumours of Germany being more open to the so-called €1 trillion package. Who knows? But this is going to be a very important part in the resetting of risk indices. Credit rating agencies have moved on a great deal since the great financial crisis, but they're essentially defensive because they are always on risk, in their view, of bondholders suing them for any kind of what they'll claim is misrepresentation or misleading a rating or failure to take account of changed circumstances. So I think you can expect a fairly steady downgrading of a number of countries as it becomes clear as to what the scale of the sovereign support package is and how long is it going to be sustained. And that, of course, is something of a reset for the overwhelming number of businesses in the economy. Whether it'll actually affect the cost of money is an interesting question. Logically, it should, and the risk environment, I think, should see an increase in the cost of money. But it's all comparative. But this is a key. It's a key factor now as to where the credit rating agencies act, and therefore what does it mean for the cost of national funding programs. And that takes us on to the backdrop of the debt market, the public debt markets, all important. But again, the same point after a pretty savage decline in the bond markets during this March-April COVID period. There's recovery. Yields are definitely higher, as you can see with the European high yield secondary trading. But one observation here, the European high yield market is only just reopening. I mean, only just. There's been one high yield sort of crossover issuance last week, a Swedish company. There are several bonds in the pipeline, and I think as you see more issuance steadily over the next 4 to 6 weeks, those yields will start falling again. And same point as the V2X, the iTraxx bond index. Again, look at the trend line. It's been running down very steadily since the last roughly 10 years. Peaked, and then we've almost at a midpoint, just over 500. Between the peak of what it was, 750. So still some way to come down, but I think as you get more issuance, you'll get more liquidity and more accuracy. So whilst volatility makes issuance difficult, both in the equity and the debt markets, as volume grows, we would expect the volatility to reduce. But there is a backdrop risk, which is credit rating agencies. So this is all a bit sort of long-winded way of saying, actually, whilst the current environment is very difficult, to say the least, the markets haven't frozen, and liquidity will improve. The bit that we don't yet understand is at what price. The whole come back to this point about valuation. That's kind of a very sort of international and sort of helicopter view. Perhaps just a couple of other points before handing over to Julius to talk a little bit about the local environment, the more local environment. Looking across all of our businesses in Europe, the States, the Far East, the level of activity is really quite interesting. Without doubt, there is a picture emerging that where governments acted swiftly and very generously, people have got more time to figure out what they need to do as and when they sort of reopen their businesses. I think that's very manifest in Germany. It's very manifest in France and the big European economies. Although the UK has been, again, very generous and, despite lots of political noise, very quick to respond. Actually, quite a lot of businesses are looking at the terms and conditions of government support and saying, well, actually, I think I want to find an alternative. Or I can do this in the very short term, but my exit strategy needs to be fast. Interesting enough, we're seeing less of that in the other economies of Europe at the moment, but it is definitely coming. The United States is too soon to say. That's more of a savage restructuring market. It has a very different financial culture. And other parts of the world, India for us, very uncertain. I think much more or less predictability than in Europe and North America. But it all comes back, in our view, to the balance sheet. How can people look out for the next 6, 12, 18 months, really to the end of 2021, realistically at this point, and take a view on what their balance sheet needs, how they can bolster the balance sheet, even with the loyalty of their banks, but they're looking at earnings decline, which probably means they're going to breach covenants and things like that. So how do they support and repair their balance sheets? There are multiple ways to do that, but we'll come back to that. I'll hand over to Julius to talk about the local marketplace.
Well, thank you, William. Very interesting. And then from what I hear, you expect this level of activity to increase, right? And then markets are not frozen, and the companies or the corporates will need to really repair their balance sheets. So this capital will be redistributed, so to say. And if the governments do not act quickly and do not provide this liquidity to the corporates, they would, as you said, turn to alternatives and look for this external capital, and that would really result in more deals and private and public gaps.
Well, it's possible. I think you make an important point, which I should have made, which is we've just talked about the public marketplace as the principal reference point, but very differently from 2008, you've got a very high volume of private money in the form of credit funds, pretty expensive, in the form of institutional investors who ranging from private equity to infrastructure funds to family offices. There is an extraordinary amount of private capital, of private capital pools out there looking at things to do. The great difficulty about private capital pools in the main is that it's a bit of a random walk in helping them invest or matching the supply and the demand. But that's a fundamental difference from 2008 to 2010. Because of the low interest rate environment, the high liquidity environment of the last 10 years or more, there is an extraordinary pool of money. But we come back to this basic question of valuation. Of course, everybody wants to do a good deal. The trouble is, in this environment, everybody's hoping it's an asymmetric good deal. And I don't believe that'll happen very much. People can work by an enormous amount of time in ways that I would never have imagined had I not been through the financial crisis. and will not, will find ways of avoiding being backed into a corner. But the fundamental is the volume of money available if you can find it.
Good. Thank you very much, William. So I'm sure the audience will have questions, but we will post them later. And now I would like to turn to Julius. And Julius, if you could have a quick view on Baltic markets and what do you see here, and how do you really expect the markets to behave in 6 to 12 months? Thank you.
Thank you. So a lot of what William said obviously applies to the Baltics, and we sort of created the data which captures, I think, that. I think from additional local perspectives that we see the obviously the process is being delayed, or let's put it this way: the things that are in early stages are fine because some people are still investing into preparing for the reopening. The things that have been advanced continuing because a lot of the commitments have been done. I mean, we've seen elsewhere in the transactions which with the colleagues have at Rothschild have seen in Europe, that if bank financing had been committed before the COVID crisis, that it doesn't tend to, banks don't tend to pull out, or among the ones that actually do could get completed. There's a degree to which the banks are much more selective, but still tend to honor their commitments. I think we've seen it in Lithuania as well, actually, on some deals closing, even though you would have thought they might have been quite well affected. So the things that are very advanced, they are not totally off the rails. I mean, some of them are in very heavily affected sectors. The things that are sort of in early stages, I think people are thinking this will at some point be over, and it will be. I think the markets are telling us that forward-lookingly that there will be a return, and there will be a new normal, not the same, but there will be a new normal. So a lot of preparation. I think at our firm we're very, very busy preparing for something. What is not probably optimal and hasn't been optimal for the past 6-8 weeks, maybe not for a couple next weeks, is to launch anything new. It's a sign of desperacy. It's a little bit unusual. So I think there is definitely, it's very serious, and there's a big disruption, but there's a lot of preparation, and then there's things which are coming to an end, I think. In terms of values, I think, obviously the values have, where they are affected, in the sectors where they are affected, the values are becoming a little bit uncertain. So people are turning to discussing the averages between last year, this year outlook. You have to review the business plans. You have to basically come up with what the new normal would look like. And in some cases, I think we've seen that it's turning into sort of the whole process turns into prolonged discussion about this point. Then sometimes the closings get delayed, and sometimes you turn to some various innovative ways of how to bridge the risk between the buyer and the seller. It can involve options, can involve adjustments or earnouts or something like this. There's I think the level of creativity that we are needing to employ now to actually bridge those disagreements. But more normally, I think you would. Well, I mean, if something is advanced, then you have to find a creative solution. If something is starting, you have to create a new business plan. If something is about to close, then maybe that can still get through the door, maybe with some adjustments, maybe creative ways of how to fund it. I think that's the sort of the Baltic sort of flavor to it that we're seeing. I think in terms of our pipeline, I think only maybe 20-30% is heavily affected, but the rest so far, knock on wood, we'll see, is proceeding on preparations or otherwise.
Well, very good to hear. And in terms of sectors, which sectors, in your view, are mostly affected or would be affected?
So I think travel, leisure, anything that relies on tourism or travel is affected and going to be affected for a very long time from our perspective. This is not a 1, 2 month, 3 month, 4 month problem. This is a year plus problem. Then you've got areas where the shutdown itself affected heavily. So all the retail except food and pharma, and which is doing extremely well. And I think there are sectors which are relatively unaffected, like food and agri. Seems to be doing quite fine. I mean, infrastructure, which is not transport infrastructure, not an airport, is okay. I mean, people still need to use it. Well, they will need to use it, after it. As airports will take time to rebound, but other infrastructure, I mean, is fine. I mean, energy is affected when you're exposed to commodities, so it's not a completely black picture. Finance is obviously affected, and as you saw from equity indexes, it's actually quite heavily affected.
But why it is so? Because finance, again, you can operate remotely. You don't need to have any physical contact, and the capital is needed. You can really continue in deploying capital,
you can. I think it's a portfolio that is expected to be affected, and the NPLs are expected to grow. Real estate is probably going to be affected so therefore that has a knock-on effect to the balance sheets. Maybe William, you have something to add as well on sectors.
Unmute, please.
Yeah. I think that what will be everything that Julia said about the sectors. I agree with. There are also some interesting considerations. There's a sort of an acceleration effect which we're seeing in the automotive industry, where the transition from diesel, petrol to electric is probably being massively accelerated. Simply because the automotive components industry is suffering enormously, very dependent on the OEMs, and therefore seeking sort of combination. And basically, there are firms that will be merged or more or less go to the wall because they're really run off old technology, and the acceleration to a changed structure in the industry is there. The other thing that it's worthwhile considering is regulated industries, because two factors. I mean, certainly in the power industry, there's this extraordinary factor of the oil price, and what that means for a number of major utilities' operating costs. Not, by the way, necessarily good, because quite a few utilities are committed to buying energy at a higher price, and trading out of that is going to be very hard and expensive. They're locked into contracts in the short term, at any rate. But also regulators are going to be looking at all sorts of utilities and asking themselves, the regulatory period can be extended. I mean, this is motorways, railways, you name it, anything that where the volume of activity has reduced very materially, and regulators are being lobbied by these firms. Indeed, probably our second largest activity as Rothschilds across Europe at the moment is working either with government/regulators or working with a range of regulated industries on how to permit the restructuring of balance sheets, and working on changes to the regulatory environment to support the restructuring of balance sheets. That's a pretty slow and long-term process. So there are quite a few less obvious and indirect effects, which will take time to work through the economies.
And then, William, how do you see this travel restriction or ban for people moving cross-border? That may affect business as well, and perhaps it's also, well, our countries, Baltic countries, we are exporting countries, and this also somehow put restriction or to our manufacturing business. And I think the fragmented Europe or markets, they may also produce some negative effects and on business and on trade as well. So just from the very general standpoint, you may say that having this fragmented economy, you have additional, how do you say, problems or issues, and not having a free trade or movement of goods, that may also have some indirect effects on economies as well.
Well, I think this is obviously a big topic of discussion. The movement of goods is relatively manageable, because if you think of it at its most basic, if it's road transportation, you can seal it. You've got one driver. You can license the driver. You can have sort of isolation practices. If shipping, again, you can take quite a lot of precautions. Air freight is a little bit more complicated. I think the biggest single issue is services. You know, in the great financial crisis, actually, far less severe than now, it was a service-led recovery. This is going to not be a service-led recovery because it is a induced recession. Therefore, it's about the revival of trade. But the movement of people cross-border, I think, is going to be a very big issue. And therefore, what does that mean? What does it mean for motorway concessions? What does it mean for rail companies? And above all else, what does it mean for the airlines? So whilst we'll do a lot more of this, we will have this new medical condition called video conference back, where we all lean back to get the best looking profile of ourselves, allegedly, I'm told by a doctor friend of mine. But the airlines, the motorways and the railways are going to feel the impact for passenger travel. I think that's what caused that's one of my biggest concerns, and it's certainly a big concern for the world of finance, which is a very sort of personal business, requires quite a lot of personal interaction. But then innovations are occurring. I'm currently involved in something not in Northern Europe, where we're doing site inspections with iPads and drones. So is that really satisfactory? Well, it's more than 60% satisfactory. But so we will just get on with things. I think things will take longer. Things will take longer.
Yep.
And
sorry.
Yeah. So don't hold your breath on timetables working.
Yeah. Thank you. I just got a question from the audience, and it very much relates to your drones and iPads. And the question was to lawyers, how this non-electronic part of due diligence process been affected, and from the practical standpoint, meetings, physical visits. So my most recent experience is that experts, they go with both iPads to the sites and really broadcasting live and showing really to some colleagues that are sitting back in the offices, almost manufacturing and other parts of the assets and broadcasting live. So at least we are using some technical equipment really to do inspections and deliver this video whatever information by technical means. So using drones, that could be also an alternative for doing due diligences. All right, thank you. So back to Julius, and just before we move to this lawyers part of our webinar, let me ask you the last question for now. It's you mentioned IPOs, and the current market situation does not preclude from pursuing this IPO route. And in the Baltics, we have a number of processes started. And Julius, do you see them continuing and having in mind that they are planned to really to be implemented in autumn, perhaps this year, or spring next year? Do you see this as a realistic scenario, and having in mind the sector and perhaps increased state regulation and revised, how to say, sorry, just yeah.
I see what you mean. I think, I mean, it's hard to predict the future, obviously, especially in this environment. But one thing generally that we are seeing and telling clients is that being as ready as possible is quite valuable. So actually investing in preparation is very, very valuable. Now, would you want to go out and do an IPO today or tomorrow? No. And as we've seen, from the market perspective, one of the most important drivers is the volatility and valuation. They're not at satisfactory levels yet. Maybe valuations are at revised levels. The volatility is not yet, but it will probably come down. So if you're looking out into the autumn or something, I think volatility might or might not be where you want it. I think it will all depend whether we get a second wave that's worse or things like that. But if we learn from the first one, we make some lessons, and maybe we don't know how to do it. Maybe it's possible. So I think it's worth investing now. What is probably going to be more important is to try to explain the effects of the shutdown and lockdown. I think what we've seen in M&A process as well is that is becoming a new stress test for companies. Is sometimes you have leverage applied and how much leverage you apply, and the new stress tests in certain sectors is that would you be able to survive COVID-19? So I think this will be probably one of the new lessons for both M&A processes, but also for IPOs, you're going to have to explain how you've survived the shutdown, what was the effect, and revise the business plan accordingly. The old business plan is probably not going to fly, so you have to make adjustments. But if you take into account the lessons, draw the conclusions, be realistic about it, and then wait for the market to allow you to reopen, then it might well happen. It's definitely more risky and might take more time.
Yeah, more risky and more expensive, perhaps. If we also may think that rating agency may review the current ratings, right, and downgrade the company or the country as such. And that
absolutely, that's all part of the revised business plan. You need to do. You mean the ostrich mentality that nothing happened is not going to work, right? You have to show that actually it did happen, but this is the effect, and this is how we can prove it.
All right, so thank you very much, Julius and William, and I would like now to move to our fellow colleagues, lawyers, and ask Elias perhaps to start introducing the situation in Baltic markets as we lawyers see. So, Elias, the floor is yours, please.
Yes, hello everybody. Although we are lawyers, I will be quite statistical today, and the reason being we are the leaders of the M&A deals in the Baltics, and we actually see the real picture. So I'm not going to talk about how deals are behaving in the financial crises. I will try to walk you through the actual situation during these 6 to 8 weeks. So the good news, which is the first one, the continuous deals are still ongoing. So the ones that started before the crisis, most of them are still on. And I will be talking about all the 3 Baltic states. There are some differences I will point out, but for that one, basically all the 3 Baltic states are on the same page. Only just a few deals didn't continue, were suspended, mostly not aborted. So this is definitely good news. For the new deals, that's a bit of a different story. In Estonia, our colleagues are saying they are pretty much non-existent, except perhaps for the venture capital funds, which are still active. In Latvia, there are some deals emerging, but quite in a lower pace. Some deals in real estate sector, energy, communications. In Lithuania, on the other hand, we actually see quite some deals still emerging. We have to say they are progressing slowly. So buyers are cautious, and it's more of a preparation rather than jump into the actual game thing. But we do see new mandates coming in. Which is in fact quite surprising, we have to admit. When we look around beyond the Baltic states, the picture looks quite different. So it is some sort of an anomaly, we have to admit. Now there's a big thing about restructurings being discussed naturally, whether they are going to happen or whether they are already happening, and the general conclusion from our side is that no significant restructurings, at least related to COVID crisis, are already happening. There are still a wait and see stage as we see it, and although we believe that there will be restructurings inevitably, that is not the case as of yet. The other thing, what is obviously happening is the government involvement, government investments, bailouts, conversion from debt to equity, etc. Again, there are talks, there are obviously some financial measures being implemented, but when it comes to investments into companies, bailouts or things like that, that is not happening. And talks, I would say, are still at a very theoretical level. Now, when it comes to certain parameters of the M&A market, of the M&A deals, we can talk about certain changes in the investors, whether these are more strategic or financial investors. And again, for now, we wouldn't see any clear distinction. For Estonia, as I mentioned, there could be some shift because new investments are not coming in. So venture capital funds are pretty much the only ones seemingly interested, but it wouldn't go for the other 2, Latvia, Lithuania. And for Lithuania specifically, I would say we see both strategic and financial are equally interested and well, fairly active. We have to make this natural disclaimer that, of course, the level of activity is less, but it is much higher, at least for Lithuania, than we would normally expect in these kind of times. Values, as some colleagues have already mentioned, are not affected clearly. There could be naturally some thoughts, some discussions already, but especially for the deals that are ongoing, we don't see any renegotiations, at least not significant ones, onto the value, which again kind of shows the belief in the possibility to earn the profits that were intended before the crisis. For the financing of the deals, again, we don't see any clear signs of the financing being suspended or aborted. The ones that were already agreed, as Julius mentioned, are still active, still valid, and again, there is no clear sign that this is changing significantly as of yet. Now, we all know that there's a lot of cash in the private equity venture capital funds ready to be deployed. So part of this activity of the financial investors is driven by that. We do see interest and for the funds to be continuing their investments. Naturally, there are discussions on the values. Naturally, there are discussions on how fast this recovery will be happening, but the funds generally are not stopping their investments. Some sectors now that were mentioned to a certain extent are healthy. It's of course difficult to say how this will be progressing, but telecommunications, for example, are doing even better than they did. Some FMCG, transport areas are doing well, pharma. And these are the areas that transactions are being looked into. Naturally, these are the kind of easier targets, easier to discuss on the value, to discuss the values, and to expect that those to be recovering faster. Now, this is pretty much the picture where we stand today, and I will ask my colleagues in Riga Tallinn to step in if I made some mistakes, but even before that, I will make some predictions. Everybody's interested in predictions, naturally, and of course, don't take them for granted, but from my perspective, one prediction, the deals may pick up even before autumn, which is quite unusual if we talk about normal summers when the deals are mostly not initiated. I would say from what is happening now, if we go out of this quarantine and the picture is becoming clearer as to the future, then there's quite some potential and expectation for the M&A market to pick up without waiting for the natural season in autumn or even beyond. The stress targets, which is something everybody is discussing in the crisis times and expecting them to be emerging, I would say this is not going to happen before next year or even later, if at all. The stress, as we saw in the last financial crisis, are not appearing right away. So not before the banks start their foreclosure procedures, not before the sellers understand that this is kind of the end of the game and reduce values, etc. Financing, on the other hand, may become more difficult. That is my prediction generally. Private equity funds, as I mentioned, are eager to invest, and therefore I would predict that they will start investing even more than they did. The last state of participation, which is being discussed and on the table, I would predict that this is not going to be significant, although this seems to be a solution for certain businesses and for the state as well. It seems that there is no support in the population, and politicians are more discussing rather than doing. So I wouldn't predict that as a major support or element in the future.
Good, Elias, thank you very much. And since we are running out of time, and I would now turn to you others perhaps, but Gunter, Peter, please stand up or just if you want to add anything, just feel free to do that. If not, so I will pass this on to Juozas, and Juozas would describe how the deal terms are changing now, or what we as a lawyer see really in negotiation and terms of the agreements. Juozas, if you could now take over.
Yes, thanks. I will share. If this can be seen.
Yes, we see.
Yeah.
Okay.
All right. So the pandemic has indeed impacted the deal flow as such, but also the way the deals are negotiated. And I would single out three main areas where those changes are most visible. I would say, first, the timeline of the whole deal process. Second, there's a shift in focus in the due diligence exercises. And third, a number of most important items in the transaction documentation are viewed and negotiated in the new light. As to the timeline of the deal process, it is extended more in those deals which were caught by the pandemic very early. So in those, unlike in the well-progressed deals, additional time may be necessary for reapproaching valuation, the financing, even to reassess the viability of the deal as such. If there are some circumstances where the sector is particularly impacted, or the target is dependent on several material contracts which cannot be performed as before. So there's a potential extension of the overall timeline of the deal process for sure. As the due diligence, it has transformed to an extent in such a way that instead of the usual risks to watch out, there's an overarching objective to assess the impact of the pandemic on the business as such. And this demonstrates itself across several different areas of interest. For instance, if we look at corporate matters, so we are now interested in new things, such as whether the online corporate meetings were held properly. Are the crisis management policies in place, contingency plans in place? In finance, covenant breaches now particular focus. State emergency funding, was it applied for? Was it received? In employment, internal rules, processing of personal data, medical data, for instance, of possible cases of infection in larger companies, manufacturing companies. Although not really likely in Lithuania, but potential claims by employees against the employer for not handling the infection properly at the workplace, for instance. Most important, perhaps, material contracts, notices regarding suspension of contracts, and assessing the possibility of damage claims against the target if the contracts cannot be performed properly. Supply chain risks, potential customer loss, reduction in business areas. In insurance, well, often the question is there any policy cover for losses related to pandemic? Where's the line where you can expect something or not indeed? Now if we turn to deal terms, one of the terms which we will see negotiated specifically and differently, perhaps from the period before the crisis, is the purchase price mechanism. The usual topic of whether it should be adjustment at closing, or it should be locked box. And buyers are likely to push for closing accounts more, so that its negative impact on the business can be captured in the price. Sellers will naturally prefer a lockbox mechanism, and at least in the broader region, we can see some hybrid mechanisms proposed, where you probably refer to the lockbox accounts, but certain balance sheet elements might be reassessed at closing. Earnout, a separate topic. It's an old idea, but I would say it's now popping up more often when the buyers willing to motivate the sellers to keep the deal running after the buyer has, in those deals that have started not long ago, where the buyer has reviewed its valuation down. Earnout is now becoming a sort of a topic which has to be discussed. For the sellers, definitely significant uncertainty because of possible adverse effect of choices by the buyer post-closing. And those choices will be made in the time of crisis. So earnout remains, as previously, a very complicated pricing mechanism, but it's now in the new light. It is considered as something that might save some deals from being suspended. Purchase price deferral. Now there's now increased motivation for the buyer to negotiate this deferral to secure indemnity, warranty claims, because the seller might potentially be insolvent in some time. And from the seller's perspective, and vice versa, no price deferral, because potentially some buyers could be in a more difficult situation when the time comes for the purchase price to be paid in the future. So this is the discussion that will be held more and more in this regard, and this is how the pandemic is impacting the negotiations in this area. Probably a compromise solution might be escrow, where the balance is found for both parties, but it remains to be seen whether it will be more prevalent. Next, I mentioned in the beginning the potentially extended timelines for the process. And it is expressed in the deal terms when defining the long stop date. Earlier, it was 4-6 months before closing of the deal after signing. Now, 8 months could be quite normal. There might be even considerations to have some automatic extension of that long stop date due to some circumstances that would be related to the containment of fallout from the pandemic in the longer run. Pre-closing covenants, also some new light on this condition, which means the undertakings of the sellers to run the business in the ordinary course before closing. Now it will need to include some measures, some possibility to take measures for the management to preserve the business if that's necessary. And the buyer's approval may be needed for certain actions, but for those actions which are emergency measures, there should be an exemption. So you will see some adjustments in those conditions going forward. I would like to make a short point about warranty and indemnity insurance, which has been an increasing trend in Europe before the pandemic. Now what the brokers say in Europe. So they have seen a significant decrease in insurance requests, about 80% less in certain jurisdictions. But even in those countries where it still remains on, Mainly those inquiries are for targets in real estate and tech sectors. So the sector is very specific for those warranty indemnity insurance mandates. And mostly there are now COVID-specific exclusions of coverage. It depends on the target sector. Like in real estate, they are excluding solvency, default of tenants, etc. But now that this topic is, of course, approached much more cautiously by the insurers. And to finish my last remarks about material adverse change. Of course, this is something that has been used for quite long, and especially after the last financial crisis, it remains quite prevalent in the transaction documentation. But again, there are some modifications expected in light of the COVID situation. So the sellers would be willing expressly to carve out pandemic-related risks. But there will be exceptions. There will be extraordinary circumstances, like termination of essential contracts, where this will remain in the material adverse change clause. And probably, as before, for those MAC clauses to be workable at all, they should be based to the extent possible on the company results, not on the market industry results. And their careful drafting is necessary, of course, for those clauses to be workable. So those were my several remarks on the deal making in these times, and I want to thank you for the attention and hand over to Vidmantas.
Thank you, Juozas. Thank you. So both are the terms or changes in terms that we see today, and we continue working on transactions. And if during the peacetime we have like 8 to 10 transactions each quarter in the Baltic states, I mean our firm, so we continue working on the same pace today as well, and we are negotiating deals. And so what was presented by Juozas, that's the real story from the field, so to say. But just we are now 1 hour and 10 minutes as a discussing, and I would like to ask audience to present their questions so that we use this opportunity to really ask William and Julius and our lawyers to answer the questions. So while we wait for the questions, I just remembered. So yesterday it was announced that in the US there is an initiative by one congressman really to discuss banning the mergers and consolidations during this pandemic. And the rationale behind this is that really that could be an opportunity by stronger, taken by the stronger to really to consolidate or merge into or swallow those weaker ones. And if we look at the situation in the Baltic markets, I think certain sectors are already heavily consolidated, and look at the banking sector, insurance, or retail, pharma, both are concentrated sufficiently. And what do you think about this further consolidation, and if the state would really consider allowing the businesses concentrating its market or their market shares more? Is there any good in that, or should we really take the approach that is now considered in the United States, that we should really somehow limit concentrations at the moment? I don't know, William, what do you think?
This question of the extent to which capital and strong companies will exploit the situation, well, maybe. I mean, I think there are. I saw this item in the States. I gather this guy is heavily involved in sort of US small business associations. I know no details, but the three things that are clear to me at the moment is, first of all, antitrust considerations. A big factor will be in the survivability of the target. Again, this is sort of about reinforcing the balance sheet. So we already have indications that certain steps would be favorably looked upon by antitrust authorities in the EU. Let's see. Secondly, regulators are sending messages to banks saying they will not look favorably on them financing M&A if they have not supported their existing clients or supported existing clients' business growth and capex and so forth. This is a soft message, but I think M&A financing out of the banking market will be subject to discouragement in a number of jurisdictions where they are concerned about the availability of bank finance for smaller businesses. And then thirdly, there's the geopolitical. And as I'm already involved in one instance where we had presented a group of investors to the European Commission for a major investment in Southeast Europe. And the message explicitly, not quietly in a corridor, whatever the equivalent for corridor is now, is no Chinese.
Okay, no chance, no chance.
No Chinese. Now, quite a strategic asset in many respects, so it's not particularly surprising. But it wasn't even a soft whispering in the ear or an indirect phone call. It was no Chinese. Very.
Yeah. Well, so the world is changing, and from global to local, we are moving now, and the states are becoming more protective, which is perhaps natural in current circumstances. But yeah, so that also affects a deal making and activity level in our markets. Good. So I see that we do not have any more questions from the audience, and now I would like to ask if any of the participants would like to add or anything or ask questions to each other.
I would just perhaps a couple of further observations. I'll be accused of beating my own drum, but we come back to this business of the balance sheet quality, and I think there is caution across the banking sector. They are worried about corporate client balance sheet quality. Covenant tests, tend to happen June, end of the year. So that's going to become apparent come sort of August, September, and then thereafter. It may not be very severe, but the banks face a moment of reckoning in their full year audit. So they're going to be, already take UniCredit. They have already at their of the first quarter results announced 900 million euros worth of essentially forward-looking NPLs. This is going to accelerate. Now, the bulk of those are in Italy, but this is going to accelerate, partly because of the ECB funding structure encourages it to promote prudence. Not a bad thing, but we are going to the logical cycle will be can you accommodate my breach of covenants? I'm looking early for my 2021 and beyond business plan. Earnings, are reduced. Therefore, the covenant pressure just grows over the next 18 months. What sort of pressure does that put on NPL provision? And then where do I, what actions do I have to take to reinforce my balance sheet in order to compensate for the various covenant tests? And that's where I think the private and public equity markets are going to see more activity. So the logic of that is in the fourth quarter and beyond, we should see more activity of a variety of scale. So the authorities will be desperate for this not to become another financial crisis. One has to look at this very selectively, but by institution. Clearly, the banking system is in a much better condition than it was in 2008, 9, and beyond, particularly in North America and the UK. Not so within the Eurozone, but so that'll be the next major concern, and that will have consequentials for the public and private equity markets, and maybe for private credit. I'm a little less sure about that given costs. So that's how we see. I would expect the natural flow of events. It always takes longer than you think. As I alluded to earlier on, never forget how long we can all survive on the smell of an oily rag. I take my hat off to corporates who manage to do that in tough times.
Thank you very much, William, for your views and insights, and Julius, Elias, Juozas, anything to add or to?
We have some questions from the audience.
All right. Okay. What is your leverage as a buyer in this environment to walk away from a signed deal, assuming the SPA did not have any marks or other provisions that are getting more common today? This week, we saw that Victoria's Secret might be left on thin ice by private equity suitor. Another unwanted purchase may be Europe. So what's your leverage as a buyer to walk away from the signed deal? Well, that's a legal question, right? Joseph, can you take it?
Well, if there's indeed no...
I assume this is under Lithuanian law, and Victoria's Secret deal is subject to Lithuanian law.
Well, I think if it's indeed not subject to any max in that SPA, which is would be quite interesting to see, but not very ordinary. But what I would do, I would try to explore the concept of hardship, meaning that if indeed this deal was signed before the pandemic started or before the actual severe negative impact was clear and known to the parties, then at least in Lithuanian law, we have some provisions which allow for the parties to either request amendment of contract or even to terminate it if it was not it was not in the for the parties to forecast that kind of impact, and obviously they cannot control that. So I would look into the hardship provisions.
Hardship provisions one, but perhaps it's sometimes in some cases it's more wise to really to pay a breakup fee than to continue and close the deal and to take over the asset in case of this severe change of circumstances. So it's sometimes it's better to walk away fines and
Sure.
legal fees.
Can
But yeah,
just I mean, this is a very lawyer-like response, but again, some things that we're seeing, people are just either politely agreeing to wait because they don't want to get into a fight, or as we've seen a number of circumstances, buyers have just turned around and said, come after me if you want to, but I'm not doing it.
Okay.
That may well end up legal opportunities, but in litigation. But it is. I'm well aware of a number of circumstances where effectively the buyers and sellers, always in very specific circumstances, have either politely agreed to wait for 2 or 3 months, or not so politely ended up saying, I'll see you in 3 months' time. I think realpolitik here is pretty powerful. You see it, and that's happened at some quite big deals. It makes perfect sense to wait, and people just worry whether the cost of enforcement is worth the effort in these circumstances.
Yeah, that's true. And Julius, we have a question to you. Would you see any long-term positive impacts on our region in relation to COVID-19?
Actually, it's. I mean, our biggest. That's a more economic, broader question, which is actually quite interesting. I mean, the big problem with the Baltics have always been that we are small, and the number of people and how many people you can get sort of here is small. But I think what this COVID situation is doing is that a lot of things are going online, and the acceleration of real to digital is accelerating. Things that had to happen for a long time are happening much faster, and it will have a lasting effect. And I think with the businesses that the Baltics have recently been strong in, sort of in tech, in innovative sort of online solutions and things like this. This is where the markets can expand significantly beyond the physical borders, right? And even not just the borders, but actually with the trends, sort of physical to online accelerating, you can actually have your business model actually get a boost as well. I mean, we have, I think, several names in the tech industry that would benefit from either shift to online to delivery to home versus physical brick and mortar to cybersecurity to other things. I think there's actually does open up a lot of opportunities post COVID, but that's for the next 12-18 months.
But even now, after sitting for 6 weeks in quarantine, for us lawyers, we just realized how quickly we can transform from traditional law firm to e-commerce, organization. And now we have like 100 lawyers sitting and working remotely and connected into one grid and then delivering service. So it's really, it's like an eye-opening moment, and then you start thinking, why do you need both, high street offices and all that infrastructure if you can really operate this easily and deliver service?
Yes, and the number we see from project execution, sort of, I think what William and others have been referring to in terms of due diligence, much more happening online and remotely. Which we had processes which were ongoing, and we had all these site visits and workshops planned. Physical would have been flights, meetings, days on travel. It's not possible now. We have to do it otherwise. Okay, we might need to do 2 workshops instead of 1, and maybe a little bit of misunderstandings from no physical contact, but actually a lot of time being saved.
Yeah, exactly. Yeah, foreign traveling. That's true. How much time do we spend on boarding the plane and flying from one place to another? And here we are. We have this webinar organized very easily. And yes, so we have greetings from Paris. Someone is sending greetings. Very nice to hear that we have audience or listeners from all over the world. And so thank you for this informative session on the situation in the Baltic region with common issues to be addressed in M&A processes at the moment. Good, and we have the last question. That's a lawyer question, perhaps. What do you think can be measures allowing evaluate whether the company is ready for pandemics as new item in stress test and business plans? What can be the measures allowing to evaluate? How?
I think I may have mentioned earlier that there is going to be a stress test on companies in M&A, and we've seen that in some areas where actually, the scenarios for people not to lose all the money are going to be such that you apply the capital structure to the acquisition, such that you don't go bankrupt if you have to shut down physical locations, and survive sort of another COVID. It's maybe a 1 in 100 years event. Maybe it's not 100 years. I mean, but clearly once it happens, I mean, we hear from investors they want to see how you managed this and how other companies would manage it. So it would have an effect on leverage, I think, and the business, and how much the business was really affected.
Or we can use our prime minister's logics just to rephrase. If a company cannot survive a month being closed, then it's not a good business.
Not a good company. A stress test, really. 1 month with no income and no earnings. Just, why not? Good, gentlemen, and thank you very much. And it was really nice to see you all safe and healthy and working and working. Well, I enjoyed very much the discussion, and it was informative and useful, and it's always good to reconnect and to see you doing fine. So thank you very much, and I wish you a nice weekend. Please stay healthy and safe, and enjoy this moment. So slower life, so to say, and a chance really to rethink and to transform. So thank you very much. Thank you for joining us, and I look forward to seeing you soon in more, say, physical form.
Thank you very much, Irmante.
Thanks a lot. Bye-bye.
Thank you, gentlemen. Bye-bye.